Hey friends, welcome back to the channel. I'm Iggy, your friendly investing iguana. If you're new here, I cover everything from stocks and finance to retirement planning and global economic trends. Fun fact, the investing iguana was ranked 8th in the 2024 Influential Tigers by Tiger Brokers. With over 768,000 reads, 53,000 likes, and 700 plus videos under my belt, we've built an amazing community of investors. Today's topic is a big one, Singapore's Budget 2025 and how it impacts two major REITs, Capitaland Integrated Commercial Trust, CICT, and Fraser's Centrepoint Trust, FCT. Trust me, there's a lot to unpack here, so grab a coffee or tea and let's break it all down. Let's start with the basics. Singapore's Budget 2025 is all about resilience and growth. The government has rolled out measures to help households cope with rising costs while boosting spending in the economy. For instance, households will receive SG60 vouchers worth $600 to $800, $800 in CDC vouchers, and $500 Life SG credits. These will be distributed between May 2025 and January 2026. That's a lot of extra cash flowing into the economy. Now, why does this matter for REITs like CICT and FCT? It's simple. When people have more money in their pockets, they tend to spend more on things like groceries, dining out, or shopping for clothes. And where do they go for these activities? Malls. Both CICT and FCT own some of Singapore's most popular malls. FCT focuses on suburban malls like Causeway Point and Waterway Point, places that are always buzzing with families and residents. Meanwhile, CICT owns iconic properties like Plaza Singapura and Raffles City, Singapore. More spending means higher foot traffic in these malls, which directly benefits the REITs through increased tenant sales and rental income. Let's zoom in on suburban malls for a moment because they're a key part of this story. Imagine you live in Woodlands or Tampines. After work or on weekends, where do you go? Probably your neighborhood mall for groceries, a quick meal with family, or even a haircut. This is why suburban malls are thriving. They're convenient and cater to everyday needs. Take FCT as an example. Their malls are located right in the heart of residential areas. Causeway Point near Woodlands MRT is always packed with shoppers, while Waterway Point serves the growing Punggol community. FCT has an impressive occupancy rate of 99.7%, which means almost every shop space is rented out. On top of that, their rental rates have been climbing steadily thanks to strong tenant demand. Budget 2025 adds fuel to this fire by putting more money into people's hands through vouchers and rebates. Analysts are already predicting retail sales could grow by 3 to 5% year on year because of these measures. For suburban malls owned by FCT, this means even more foot traffic and higher tenant sales. Here's another interesting angle, HDB flats. The government plans to launch 50,000 new flats by 2026. Why is this important? More flats mean more people living near suburban malls like Hougang Mall or North Point City, both owned by FCT. This creates a steady stream of shoppers for years to come. CICT also benefits from this trend with properties like IMM Building in Jurong East, a hotspot for outlet shopping, and other suburban assets that will see increased footfall as nearby residential areas expand. It's like planting seeds today that will grow into bigger harvests tomorrow. Budget 2025 isn't just about consumer spending. It also has something for investors. The government has extended the 10% final withholding tax rate for non-resident S-REIT investors until 2030. What does this mean? In simple terms, it makes Singapore REITs more attractive to foreign investors who want stable returns. There's also good news on tax transparency rules. These now cover co-working spaces and overseas income streams. For CICT, which owns properties in Germany and Australia, this means smoother operations and better net income. These tax changes make Singapore REITs even more appealing on the global stage. Both CICT and FCT have been making strategic moves to strengthen their portfolios. Let's start with CICT. Last year, they acquired a 50% stake in Ion Orchard. Yes, that Orchard Road Mall everyone knows. This adds $240 million in annualized net property income to their portfolio. At the same time, they sold off underperforming office assets like 21 Collier Key for $1.2 billion. These moves are all about focusing on high-performing assets while cutting dead weight. FCT isn't slacking off either. They've been upgrading their malls through Asset Enhancement Initiatives, AEIs. For example, Tampines 1 recently added over 9,000 square feet of lettable space after renovations. This not only attracts premium tenants, but also increases rental income. Of course, no investment is without risks. Interest rates remain a challenge for REITs because higher borrowing costs can eat into profits. FCT's borrowing cost is around 4%, but thankfully rates have stabilized after recent Fed cuts. Another potential risk is competition from Johor Bahru when the RTS link launches in 2026. Some shoppers might cross the border for cheaper goods, but here's the silver lining. Developments in northern Singapore like Woodlands Health Campus could bring more people back to local malls. So what does all this mean if you're an investor? Both CICT and FCT offer stable dividend yields around 5.7 to 5.8%. That's pretty attractive compared to other investment options right now. CICT stands out if you're looking for exposure to prime locations like Orchard Road or Raffles City, Singapore, places that attract both locals and tourists alike. Meanwhile, FCT is perfect if you believe in the long-term growth of suburban malls that cater to everyday needs. All right, friends, let's recap what we've learned today. Singapore's Budget 2025 is a game changer for retail REITs like CICT and FCT. On one hand, consumer spending boosts from vouchers will drive tenant sales at malls across the island. On the other hand, long-term factors like new HDB flats and tax incentives make these REITs even more attractive investments. If you're thinking about investing in REITs or just curious about how they work, now might be a good time to explore your options. Before we wrap up completely, don't forget to check out my previous video titled Singapore REITs Crash, Biggest Buy since 2020. It dives deeper into why REITs can be resilient investments even during tough times. Thanks so much for watching. If you found this video helpful, give it a thumbs up and share your thoughts in the comments below. Are you bullish on Singapore REITs? And don't forget to subscribe so you don't miss future updates. Stay smart with your investments, stay curious about opportunities, and I'll see you in the next one.